Hey everyone, it's Mark, CEO of Secure Choice Lending, coming to you today for a May market update. What we're going to discuss today is consumer debt, inflation, interest rates, right? What has happened over the course of the past 30 to 60 days with the fact that interest rates have increased over 2% in the past 90 days, and what's that done to our inventory? What has it also done to price cuts, things of that sort, right? So let's jump into it. So the first thing we want to discuss today is what has happened to inventory since interest rates have increased over the course of the past 90 days. Well, first and foremost, what we've seen is a massive increase in price reductions in homes. Price reductions are rising rapidly, and here in May, we've seen the largest jump in weekly price reductions in quite a while. Currently, 21% of homes on the market have seen a price reduction. This is moving much quicker than last year, but still much slower than the years of 2016, 2017, 2018, 2019, and even 2020, right? So available inventory is up to 318,000, which is at 4.2% from last week. So even though price cuts are increasing, right, it's still important to know that it is much lower than the past 4 years or past 5 years, right? And it's seasonal as well. We should technically start to see price cuts increase in the months of May, June, July, and even increase even more the back half of the year, right? And we can see that from the data. So according to Realtor.com, we've had the first year-over-year inventory increase since 2019. So what does that mean? That means if you look at where inventory is today compared to where it was May 15th, May 16th, May 17th of 2021, it is the first time that we've seen an increase in inventory from previous years. And you can see that's been a dramatic difference from the past 3 months, right? In January, we're about a 50% decrease in inventory, and now we're just about flat, we're about even. So it's important to note interest rates has officially caused this demand to kind of slow down, which has caused our inventory to increase. Also, we're going into the summer seasons, which we knew inventory should theoretically start to increase during this time. So now it's gonna be important to note how much will inventory increase over the next 3, 4, 5 months. That being said, demand is still plenty strong. Even though inventory is going up, did you know that the median price for a single family home just hit a record high at $435,000? So inventory may be increasing, but it's not stopping our current price appreciation over the past few months, right? Remember, this is also seasonal. As we can see from the chart, we can see that price increases generally start from January to May and then slow down the back half of the year. So I do anticipate a new record probably next week or even the following, maybe capping out around June. And then we'll start to see those price cuts and how the demand is slightly slowing will start to affect the values of these homes and these record highs that we're currently at. In addition, 25% of new listings went into contract in under a week. So we can clearly see there's still plenty of bidding wars going out there for the sellers. Now let's move to interest rates. Interest rates have officially hit a 13-year high. According to the Freddie Mac Interest Market Survey, the average interest rate last week was about 5.3% with slightly about a 1% discount point. We've seen over a 2% interest rate increase in the past year. This is the largest increase in a 1-year time frame in over 40 years. So the interest rate increase has certainly, been dramatic to say the least. We're at a 13-year high. We've had the largest 1-year increase in over 40 years. It's been very difficult for a lot of homeowners and, potential buyers out there calling them 6 months ago or 3 months ago and saying, hey, we're able to offer you a 2.875, a 2.99 interest rate. And then today we're calling those same consumers and saying, hey, we're offering you about a 5.3. a 5.5 interest rate. So it's been difficult, and that's been the real stem of the problem of why inventory is starting to go up and demand is starting to weaken. Now, where do we see interest rates heading? That's a difficult question that no one really has the answer to. What I can evaluate is that the 10-year yield has been in a long upward channel for the last 6 months. We have finally broken that upward channel this week, right? Does that mean that we might have a slight dip in interest rates? Possibly, but it's something we don't know, but it's important to keep an eye on the chart to see what comes next. In our previous videos, we went over that fact that adjustable rate mortgages were about 1 in every 100 loans. Well, ARMs are officially starting to make a comeback. We can see that the US mortgage market share of mortgage applications with adjustable rate mortgages have increased to over 10%, its highest share since 2008. Now, why, you may ask? Why are homeowners and consumers opting for an adjustable rate mortgage over a fixed rate mortgage? Well, that's because the spread between an adjustable rate mortgage and a fixed rate mortgage has only increased the past 6 months as well. So as you can see from the chart, the interest rate spread between a 30-year fixed and a 5/1 ARM is slightly below 1.5%. So when you look at that from a $400,000, $500,000 mortgage, that's gonna be over $4,000 in annual interest and principal payments. Now let's talk inflation and consumer debt. Inflation dipped for the first time since last summer. In March, we were about 8.5% inflation. In April, we saw about an 8.3% inflation rate, right? So a small dip. That being said, at 8.3%, we're still at 40-year highs for our inflation rate. And remember, the main flaw with inflation right now is that the Fed is measuring shelter, which equates to 33% of the inflation index, at only a 5.1% year-over-year increase. Well, for those who are in the mortgage industry, and for those who may be renting out there, we know that mortgage home prices, mortgage payments, rent prices have appreciated well more than 5.1%. So how the Fed is deriving a 5.1% increase in shelter when rents are up 16.4% and mortgage home prices are up 20% is really hard to figure out. So with that said, in my opinion, I believe the inflation rate is higher than our current reported numbers of 8.3%. Now, consumer savings. Looking at the chart below, we can see the true impact of the COVID era stimulus payments, as we saw massive spikes in consumer savings during 2020. However, sadly, the United States has already fallen back to pre-COVID levels, and any saving cushions Americans may have had are back to what they once were. And remember, this data only goes to the end of 2021, where we've seen a massive increase of inflation in the first part of 2022, right? Where gas prices have really started to increase in, February, March, and April, right? So if consumer savings were already back to our pre-COVID levels at the end of 2021, it's hard to imagine where they're at now in May of 2022. Now, another point to show that Americans might be hurting from the current inflation rates is that consumer debt has soared to its highest point in over a decade. What does this conclude? This concludes that Americans are likely swiping their credit cards to offset the increase in gas prices, the increase in shelter, the increase in rent, the increase in food, right? So if their savings have already dwindled and their wages are not increasing at the amount that inflation rate is, what are they reverting to? They're reverting to, swiping their credit cards, which is why consumer debt is the highest it's been in over a decade. So with all of this data, where does that leave us? Well, the US is already currently 50% into a recession. Remember, a recession only means 2 consecutive negative quarters of GDP growth. Well, in Q1 of 2022, we saw negative 1.4% GDP growth. It's hard to imagine that Q2 of this year will also not be a negative quarter of GDP growth. We have the Ukraine-Russia war. We have supply chain issues still here. We have China in lockdown for most of this quarter. We have stocks bleeding to the lowest points that they've been in quite some time. I saw a stat the other day that the NASDAQ has lost the second most value it's ever lost other than the 2001 dot-com crash, right? So it's hard to believe that Q2 will also not see a negative GDP growth. Yet the market is still pricing in several interest rate hikes the next few months or even to the next few years. So this leaves the Fed in quite the predicament. What we're seeing now is the Fed is increasing interest rates to combat inflation. But if we're already 1 quarter into a recession and likely a second quarter, of negative GDP growth, what does the Fed do? Normally when we enter into a recession, the Fed lowers interest rates to help stimulate the economy. So they're in, a pickle, right? Do they continue to increase interest rates to slow down inflation? Or will they maybe slow down these interest rate hikes to help stimulate the economy? It's a very important data to be watching over the next 3 to 6 months. Thanks everyone for watching. We appreciate it. We'll try to do more of these market updates here in the upcoming future. Try and do one every 2 weeks, maybe every month. So if you have any questions, please feel free to reach out. We'd love to, engage with you guys in our next video.